Ladies and gentlemen, in today's video, we're taking a deep look at a major shift happening inside NIO, a shift that many long-time followers of the brand probably didn't expect to see this soon. According to NIO's president, the company is now entering what he calls an ultra-focused era. This isn't just a catchy phrase or a short-term marketing line. It represents a complete change in thinking, spending, strategy, and long-term goals. After years of big ideas, side projects, experimental ventures, and massive investments, NIO has officially declared that its future success will depend on doing fewer things, but doing them at the highest possible level. This change is already affecting decisions across the company, from technology development to partnerships, from product planning to cost management. So today, we're going to break down exactly what this means, why it matters, and how it could reshape NIO's path toward profitability and long-term dominance in the EV industry. This is not financial advice. Please do your own research. NIO's president recently made a very clear statement. The company is now embracing a highly concentrated strategy. He explained that the next generation of successful tech companies will not be the ones chasing every trending idea, but the ones that narrow their focus and execute exceptionally well in a few core areas. Compared to how these young tech companies behaved in the past, he said the new direction is leaner, more disciplined, and built around achieving mastery, not pursuing distractions. For years, NIO explored several unique projects, some truly innovative, others more experimental. But now, the leadership is drawing a clear line. The company's main mission is to design and manufacture world-class vehicles. That's the center of everything they want to build. They're not chasing every futuristic idea such as flying vehicles, humanoid robots, or running their own robo-taxi networks. Many of their competitors, including XPeng and Tesla, are investing heavily in these fields. But NIO has decided that spreading itself too thin does more harm than good. Instead, they're concentrating on perfecting the essentials: automobile engineering, core vehicle technologies, and a strong return on investment. This includes major components like their advanced in-house chips. And this focus is exactly why some observers believe NIO is positioning itself to become an extremely powerful and profitable company in the long term. Real investors need to hear both sides of the story. When negative developments occur, you deserve to know, and when good things happen, they also deserve attention. But once the bad news is explained, there's no need to keep repeating it. What matters is understanding the full picture, not just the positive parts. And the good news is significant. One of the biggest developments right now is the partnership between NIO and OmniVision. Through this collaboration, NIO is supplying its NX9031 chip, a high-level autonomous driving processor for OmniVision to use and distribute. Nobody knows the exact value of this deal yet. Some estimates suggest around $100 million, while other insiders in China believe the number could be much higher. However, the exact figure isn't as important as what the deal represents. This partnership opens the door for NIO to generate substantial revenue by becoming a supplier of advanced autonomous driving chips, something similar to what NVIDIA does in the AI industry. Instead of trying to be the company that builds every AI product, NVIDIA built the hardware that powers every AI product. That strategy turned them into a giant. In a similar way, NIO is recognizing that instead of fighting over every futuristic robot or autonomous platform, it may be smarter to sell the core technology that everyone else needs. And that's exactly what they're doing. NIO is pulling back from expensive, high-risk categories like robotaxis. Robotaxis require enormous capital, constant maintenance, and a long, slow path to profitability. They also involve serious regulatory pressure and heavy liability exposure. Even though NIO's battery swap system would be perfect for a fully autonomous taxi fleet, since the vehicles could independently drive into a station, swap batteries, and return to service without human help, the company has decided that the return on investment simply isn't strong enough for now. You can let me know in the comments whether you think NIO should pursue robotaxis. I think they would excel at it. But their leadership has made it clear. If a project doesn't show a strong financial return in a predictable time frame, it won't continue. The same goes for robotics. Many tech companies are investing billions into the robot race, trying to create consumer-friendly machines that can help with daily life. But this field is extremely competitive and very expensive. Profitability is nowhere close. For NIO, diving into this space might lead to endless spending without clear rewards. So instead of making robots, NIO is choosing to sell the chips and technologies that power robots. Again, this mirrors NVIDIA's strategy, being the company that provides the shovels in the modern gold rush. Another major shift relates to their smartphone business. NIO introduced its own smartphone line as part of the broader ecosystem strategy. While innovative, it also required a lot of money. Now, however, the company plans to discontinue the NIO Phone series after the third generation. This decision shows that the new leadership mindset is fully committed to removing any form of unnecessary spending. And speaking of finances, let's talk profitability. In the past, NIO's CEO said that the company needs consistent monthly deliveries of around 50,000 units at healthy margins to reliably achieve profitability. Recently, the lowered guidance has made hitting that threshold more challenging. This doesn't mean profitability is impossible in the short term, but based on the numbers, it's not the most likely scenario for the current quarter. Still, long-term prospects look far better. Another battlefield where NIO must remain extremely competitive is battery swapping. The competition is heating up. Companies like AN are already releasing vehicles compatible with cattle swap stations. The battery swap landscape is evolving rapidly, and NIO now faces direct rivalry not just from other automakers, but from battery technology providers as well. NIO's approach is targeted. They focus on premium, liquid-cooled, high-performance battery swapping. CATL's model is more affordable, faster, and aimed at commercial or fleet use. Both strategies make sense for their respective audiences. What matters for NIO is that they sharpen their execution. One good decision was to avoid building separate swap stations for the Firefly brand. Originally, the plan was to create entirely separate infrastructure, which would have been extremely expensive. Instead, all vehicles including Firefly will share the same fifth-generation swap stations. That's exactly the kind of cost discipline the company needs. Beyond vehicles and battery swap, NIO is also licensing more of its technologies. Their expertise is now valuable enough that companies like McLaren have reportedly sought their guidance and paid technology consulting fees. This shows NIO's internal capabilities are gaining global recognition. Meanwhile, other tech investments like consumer robotics or autonomous fleets may take many years before becoming profitable. Nobody knows how much capital the leading companies will need or when revenue will materialize. NIO is avoiding that uncertainty by choosing a more reliable, more financially disciplined path. Looking forward, while I think Q4 has a low probability of turning profitable, I do think that the third and fourth quarters of 2026 could be the point where NIO finally crosses that line. The combination of stronger sales, cost reductions, chip revenue, and government support is building a foundation that looks much healthier than what we saw in previous years. In Beijing, for example, NIO just opened a new delivery center and received an enormous government subsidy, 5 years of free rent. Moves like this significantly reduce operational pressure and help NIO allocate resources toward technology and production instead of overhead. As global tensions increase and supply chains become more local, many companies will eventually need alternatives to NVIDIA's chips. This trend plays directly in NIO's favor, creating a huge opportunity for its chip division to capture market share. All of this brings us back to the central message from NIO's president. The company is transforming into a hyper-focused organization. They're cutting unnecessary expenses, dropping side projects, concentrating on building great cars, perfecting key technologies, licensing their expertise, and becoming a major supplier to other industries. NIO is redefining its entire strategy. Instead of chasing every futuristic idea, The company is narrowing its focus and dedicating itself to a smaller set of core priorities: premium vehicles, high-end technology, profitable chip development, and top-tier battery swap infrastructure. They're cutting non-essential projects, dialing back on high-risk investments, and improving cost control. This approach positions NIO to become more efficient, more profitable, and more competitive, especially as global demand for independent chip supply grows. The company's leadership believes that in the future, the winners won't be the companies doing the most, but the companies doing the important things exceptionally well. And based on everything happening now, NIO is trying to become exactly that kind of company. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next video.